We'll take you through some multiple choice questions for cost and management accounting, specifically for budgets. The first question we'll look at is taken from the Cambridge June 2015 paper 1-1. Question 24. Actual output for a business is higher than budgeted output. Which costs will still be the same as budgeted? Now, if you think about the fact that if output is higher than budgeted output, you would expect that your fixed costs will stay the same by definition, but your total variable costs would increase. However, your costs per unit for the fixed costs would be smaller, although your variable costs would stay the same. So let's now go and have a look at the different options that have been given. The fixed cost per unit is not going to be the same. In actual fact, it will be lower because per unit, if your output is higher, it means that your per unit cost will actually decrease. Number two, the total fixed costs should stay the same. By definition, they are fixed, so even when there's a change in production, there shouldn't be a change in the total cost. So we like option number two. Number three, the total variable cost should actually be higher because, again, by definition, variable means that when production changes, the variable cost total is going to change. Number four, the variable cost per unit, however, should stay the same because that is where we expect that the variable cost will be identical for each particular unit, and if you have a higher level of production, your per unit cost will stay the same, and that's why your total cost will be higher. So we like options 2 and 4, and therefore we will choose C as the answer. Number 25. A business has an activity level below budget and fixed overhead expenditure below budget. Do these result in an under-absorption of fixed overheads? Now, we want to see which ones will be under-absorbed, and we will want to look at them individually. Firstly, let's have a look at the activity level being below budget. In other words, we've made less than what we expected. Now, as soon as you make less than what you expected, you will generally have an under absorption because your total quantity of units you expected to be higher, and therefore your total absorption rate would be lower than what it actually needed to be. So this is a case where, yes, it will result in an under absorption. However, your fixed overhead expenditure was below budget. And in this case, what it means is that your actual cost was lower than what was expected, and therefore this would result in over-absorption because it means that your absorption rate is higher than what you actually needed it to be. And so the answer for the overhead expenditure would be no. So we're looking for an option that has yes for lower activity levels and no for overhead expenditure. In other words, we will choose C. 29. A company has the following budget. We are given revenue as $1 million, contribution as 550,000. Remember that by contribution we mean the contribution margin. In other words, the difference between the sales and the variable costs. So just by looking at these two, you can actually work out that the variable costs must have been 450,000 at this level of productivity, whatever it may be. We don't know. We are given our fixed production costs and our fixed non-production costs, and we are asked what is the budgeted break-even revenue. Now, I have to admit that when I first looked at this one, I was a little bit foxed because nowhere does it tell us what our quantity of production is over here, and we don't know what the quantity is for break-even, and I said, oh my gosh, how am I going to do this? But after looking at it for a while, I realized that although we don't know our actual quantities, we have got a relationship between what the contribution or the variable costs are compared to the sales. So in other words, we know what percentage of selling price is either the contribution margin or the variable costs, whichever way you want to look at it. And I decided then to use this to help me figure out my answer, because it is quite important to remember that the quantity produced for this budget is not going to be the same as the quantity where I have got my break-even point. That's very important to realize. You can't simply say revenue minus my variable costs and minus all my fixed costs, work out what the profit is and say, oh, well, revenue minus that particular profit will give me zero profit, because actually, if your revenue is smaller, your variable costs would also be smaller. So instead, we're going to look at the relationship between variable costs and revenue. Looking at these figures here, you can see that your contribution margin is 55% of revenue. In other words, your variable costs are 45% of revenue. So if we know this, we should realize that at the break-even point, obviously, your fixed costs should be just covered by your contribution, because remember, the contribution margin means what is available after you factored in your variable costs, what is available to cover those fixed costs and make a profit. But at break-even, there's no profit. So your fixed costs must equal your contribution margin. And so we're going to take both of our fixed costs. Now, I know that this 55,000 is for non-production costs. However, if you don't factor that in, it means that you will actually still be running at a loss. So we do need to factor them in, even though they are not particularly production costs. So we'll use all our fixed costs in this calculation, and we'll realize that our total fixed costs are 330,000. So we need to have a contribution margin of 330,000. We can then go back and use this percentage to work out if my contribution is 330,000, that must be 55% of what? In other words, we divide by 55% and we'll find that your total sales or total revenue must be $600,000. And you can always check yourself if you're not 100% sure about what I'm doing over here. 600,000 times 55% will actually give you that 330,000. The other way of looking at it is quite simply to say, well, if I worked out the contribution, I said revenue times 55% gave me the contribution, because remember, 8% is part thereof. So to work backwards, I would need to divide. And that's why I've said divided by 55% over here. So we want an answer that has got $600,000, and that will give you D. Out of interest, if you did simply do a little plus minus calculation, you actually wouldn't get any of the options here, and then you would know that you are definitely on the wrong track, fortunately. Let's now look at question 30. Which item will not appear in a cash budget? This is quite a nice straightforward one. You should be able to do it just by looking immediately and saying, well, which of these is a non-cash item? And with time, you'll realize immediately that it is actually a bad debt written off. Doesn't involve cash at all. However, if you're not sure of this to start with, let's have a look at what accounts are affected where a transaction like this takes place. Remember that bad debts, you would have debited bad debts and credited accounts receivable. So this means that your bad debts is a non-cash item and we will use it. However, if you look at all of the others, you'll see that bank is involved. If you're paying loan interest, you would debit the interest and credit bank. So bank is going to be affected. You would have to take that into account in a cash budget. If you're planning to repay the bank loan, again, you would have to factor in that you would expect that your bank amount would decrease and you would credit the bank account. And lastly, utility expenses must also be paid. So there is a bank amount involved. So for B, C, and D, they would all have to be factored in on a cash budget. However, A is not. And so A would be the answer that we'll choose. Let's now look at Cambridge, June 2015, paper 1-2. A company is forecasting its profits at 2 levels of activity. So we're looking at a budget where the sales units will be 5,000 units versus where we will produce 8,000 units. We are then given our total fixed and variable costs, and obviously you can see that they would change because our variable costs must go up. And if you have a look at this, you can see that your variable cost is the only reason why this would go up. And so the difference is going to be 6,000, and that is because of the difference in production of 3,000. Our profit then would be different, obviously, because of the change in variable costs, and it means that our contribution margin will be higher where we are producing more and we will have more money available for profit, and we are then also given our sales revenue so that we can also work out whatever we need to. So the fixed costs and the selling prices are unchanged. So we know that the fixed cost that is hiding inside here is the same as the fixed cost hiding inside this column. And our selling prices also are the same. So you can take your sales revenue and look at how many units it related to. And in both cases, you should get the same answer. So you can actually see from this, and it doesn't matter which column you use, either column, if you take 35,000 divided by 5,000 units or 56,000 divided by 8,000 units, in both cases you'll get a selling price of $7. And you can also now work out your variable cost per unit. Remember I said that we could see that there was a difference here of 6,000. So I'm going to calculate my variance there, or the difference between the two different quantities. And my difference there is going to be 6,000 divided by, in other words, that 6,000 is relating to the extra 3,000 units that were produced, the difference between the two sales units amounts. And that then tells me that my individual variable cost per unit is going to be $2. So you can then see that there's actually a contribution margin here of $5 per unit. You can then go and work out the fixed costs, and you can use either column for this. So you can either say the 20,000 at 5,000 units minus the variable costs for 5,000, which is 10, or you can say my total of 26,000 for 8,000 units minus the variable costs for 8,000. Excuse me. And in both cases, you will end up with an answer of $10,000 fixed costs, which is what we expected because we were told that the fixed costs did not change. Now we are able to actually work out what our profit would be expected to be at 7,000 units by simply saying we would expect the profit to be the total revenue, in other words 7,000 units times the $7 selling price, minus the variable cost, 7,000 times $2 selling price. Or if you wanted to, you could even combine these if you'd already worked out that the contribution margin is $5 and just say 7 times $5, which gives you your 35,000 as your contribution. And then you subtract your fixed costs of 10,000 to get an answer of $25,000 as your expected profit. You look for that in your options and you can see that you would want to choose B. Question 30. Which statement about a cash budget is correct? Again, this is just a very simple little theory question. We want to have a look and see, do we believe in these amounts, these information, the pieces that are stated or not? A cash budget, remember, has got only cash items. So we'll exclude all the non-cash items. A says it includes credit sales. No. Remember that credit sales, you would debit the accounts receivable and credit sales. So there's no cash involved. And discount allowed. Again, no cash involved because you would debit discount allowed and credit accounts receivable. So both of these are wrong. So A is definitely the wrong answer. B has got it half right. B says that you exclude discount allowed, which is correct. However, it is still including credit sales, and that part of it is still wrong. So we don't want to use B. C. It includes receipts from debtors. Yes, receipts from debtors means bank is involved because we are receiving cash, and therefore you would show the expected receipts from cash collections from debtors to go into the cash budget. However, the discount allowed has been included in this option, and we don't want that. So it's discount allowed here that is wrong. D, it includes receipts from debtors. Yes. Excludes discount allowed? Yes. So therefore, we want to choose D as our answer. Let's now look at Cambridge Specimen Paper 1, question 30. Which objectives are achieved by the introduction of a budgetary control system? Remember that a budgetary control system simply means that we are preparing a budget to see what we want our goals to be and what everything should be expected to be, but then we also control it. In other words, we go and look at what the actual costs were and we make comparisons so that we can hopefully manage our business better. So, how does it help? Number one, coordinating the business activities. Yes, you're able to look at all the different activities and look at coordinating them or seeing how they work together. So, number one is an option. Number two, encouraging communications between departments. Absolutely. If your departments don't talk to each other properly, there's no way that you're going to get an accurate budget in the first place. Number three, ensuring wage rises do not occur. Now, this option is a little bit problematic because ensuring is always difficult. This means that you are definitely going to make sure that your wage increases will not happen. Well, although you might plan to not have a wage increase, there may be factors beyond your control. Maybe your workers all decide to go on strike and you are forced into wage negotiations and an increase that you had not planned on. So cost rises of any sort cannot always be prevented. Sometimes they are beyond your control and you need to understand that they are just going to occur. However, you can better understand them through control. So the fact that this one is saying ensuring, I don't like it. If it said instead, it can help you try to understand your wage rises better, I would like it. But the way that it is, no. So therefore, we are only going to choose numbers 1 and 2